Good afternoon, everyone, and a very warm welcome to each and every one of you. I'm Neil Brown, and I'm the head of Anchor Asset Management. And thank you so much for joining us for this, which is our first Where Will the Money Be Made webinar of the year. And thank you for spending the time with us today. We do appreciate it. I hope that you've all had a wonderful break over the festive season and are relaxed and rejuvenated going into the new year. Unfortunately, most of the issues that societies, economies, and markets grappled with last year are still with us. And the whipsawing rollercoaster ride that we've been on for the last few years is certainly not over. There's a whole shopping list of major issues which continue to be high inflation, the risk of slow growth and recessions, central banks increasing interest rates, high levels of government debt, the ongoing Russian offensive against Ukraine, Europe and our energy and affordability crises, the disruption of global supply chains and China's slower growth, real estate sector issues, and COVID infections, just to mention a few. Some of these look to be coming to an end, and the market is trying to figure out when the peak pain period has been or will be reached. Shoots of optimism are popping up. The team today will share Anchor's views on the most important issues, explain how we've taken these into account in our investment strategy and process, and as a result, how we are positioned to make our clients money over the next year. We'll start off with Pete Little, who's Anchor Fund Manager, and he will share Anchor's asset allocation views and then spend time unpacking our thoughts on global and local inflation as interest rates and sticky inflation continue to dominate the discourse on financial markets. Nolan will then deal with the fixed income asset class, followed by Peter Armitage, who will cover global and local equities. Finally, we'll end off with Seleho, who will talk about the impact of climate change on investing, which is a very topical issue at the moment. We will have a Q&A session at the end, so please post any questions that come to mind during the session in the Q&A section at the bottom of your screen. We'll pick them up from there and try and answer as many as possible before we end. We will distribute a recording of this event, and for those of you who require CPD points, the CPD certificates will be distributed once we've been accredited the points by the FBI. Without further ado then, thank you again for joining us, and I'd like to hand you over to Pete Little.
Excellent. Thanks, Neil, and thanks all of you for joining us this afternoon for our first series of Where Will the Money Be Made. As Neil suggested, I'll be kind of starting off just taking us through the high level of where we think the money potentially will be made throughout the course of this year, 2023. I'll unpack the sort of macro operating environment predominantly globally, and then hand over to Nolan and Pete, who will delve into the individual asset classes and the bottom-up views there. So let's just dive straight in. This is a table that hopefully most of you will have seen over the course of the last few sessions that we have of these things every quarter, and it basically looks at the various asset classes both domestically and globally and suggests where we think, what we think the returns for each of those underlying asset classes might be over the course of the next 12 months, and also how that makes us feel about whether we're positioned on the positive or negative side around those things. The general overview here is from a 30,000-foot view. We're relatively constructive on 2023 from an asset class perspective. So equities, both domestically and globally, we think can give you a return in the teens. Even domestic bonds, we think can give you a return in the teens. And the rest of the asset classes, we think will give you sort of mid to high single-digit returns. So pretty constructive outcome. If I just look at this compared to how we were thinking about things 3 months ago when we had our last view, so I've just compared on the left-hand side here the table, the similar table that we put out in October when we had this document and webinar going on there, and then on the right-hand side here, I've highlighted how things have changed for us over the course of the last 3 months. So I think the first thing to take away is in this column here, the change in expected returns. We've basically trimmed most of the asset classes down by sort of low to mid single digits for the next 12 months. A lot of that is a function of what you see on this right-hand column, is how far the markets have come over the course of the last 3 months since we last put out our views in around mid-October, as I say. So certainly some of the asset classes you've seen in the course of 3 months, a return of comfortably in the teens, and even for the ones that haven't performed as strongly as that, you've had at least sort of mid to high single-digit returns. So that's taken away some of the big upside potential for us over the course of the next 12 months. But certainly, even once factoring that in, we come up with a pretty constructive view of where investors will end up this year in 2023. In terms of the sort of change in positioning, with an 11% yield that Nolan will unpack when he talks about bonds, we think that's enough to be positively skewed towards the domestic bond asset class. And then even domestic equities, despite the fact that we think 13% is a relatively good outcome for domestic equities, in the context of domestic bonds at 11%, we just think that wasn't really enough for us to be overweight the asset class. So just more like on a relative basis, we think we've moved domestic equities back to neutral. Global equities, we've maintained at overweight. We think a low double-digit return out of those is a pretty good outcome. And the other ones that probably stick out as pretty positive are the alternative investment suite. Pete Armitage will delve into the merits of that in his section, but needless to say that an environment where we think is going to involve a decent amount of volatility over the course of this year is a pretty constructive one for some of those asset classes. So that's the sort of top view of where we see things going over the course of the year. From my perspective, I just want to lay out, spend the next 10 minutes or so just talking about the sort of global investment environment that we think we'll be operating in over the course of the next 12 months. And it's difficult to talk about that without talking about inflation and central banks. So I'm going to start off by just talking about how we've seen this evolution of thinking about inflation. And certainly any time pre-2021, for the last decade or even two, we've seen a whole lot of structural forces which rendered inflation in developed markets, or certainly seemed like it was a thing of the past, or certainly something to not be too worried about. And there were various factors contributing to that, demographics like aging societies and shrinking populations or slowing population growth, globalization, where we're able to manufacture things cheaply in various different jurisdictions around the world, and technology, which always makes things, quicker, easier, cheaper. And so all of these structural factors we think have combined to make the last decade or two pretty benign from an inflation perspective. And as a result of that, it's meant central banks, whose primary job is to keep inflation under control or at a comfortable level, have been able to act with a fair amount of impunity every time they've seen economic or even market wobbles come to play. So in the wake of the global financial crisis in 2008, we've seen central banks come in with a lot of money printing, quantitative easing, and they've been able to do that with a reasonable amount of impunity, because with inflation being largely extinct, they weren't worried about creating inflation with excessively loose monetary policy. Now, as a result of that, markets have become sort of accustomed to the Fed stepping in as this buyer of last resort. And because they're able to err on the side of caution, every time things wobbled, the Fed stepped in. And that's been a pretty constructive environment for investors, where this money just keeps getting thrown at things. And you would argue that markets almost became a little bit codependent on this. We expect the Fed to step in every time it gets a little bit uncomfortable for investors. And then if we look forward to kind of our exit out of the pandemic in the early parts of 2021, this created all sorts of challenges where services weren't operating properly yet. Customer or civilians had great balance sheets that saved a lot, that had a lot of fiscal stimulus. They were spending a lot on goods at a time when it was pretty difficult to move goods around. And so we started to see some inflation coming through from that. And as that was coming through, we had the sort of the double blow of this war in Ukraine, which caused a huge spike in commodity prices. And so it looked like inflation was coming back to life for the first time in a decade or two. But we were able to largely dismiss this initially as something that was transitory. We were kind of just getting the economies reopened after the pandemic. We thought that would kind of happen fairly quickly and those problems would be out of the way. The commodity supply shocks, we thought we would be able to kind of reroute supply chains and figure our way around that and ultimately kill that source of inflationary impact. And so we were largely looking as inflation as still extinct, but with a little sort of blip on the radar, which would disappear over time. And then as inflation stuck around longer and longer, it became more and more uncomfortable, to the extent that it started expanding into services and housing, and things that were generally stickier and less transitory. And so we've now shifted from an environment where you could completely ignore inflation to an environment where we realize that actually inflation can come back. It's not as extinct and as we thought it was. And we think that this means that central banks will have to act a little bit more prudently going forward. And that will result in probably some more volatility, just given that they'll have to tolerate a bit more, certainly financial market volatility before stepping in with their Fed put. That's pretty much all in the history books. Now, where do we see this? How do we see this playing out going forward? So before we dive into actually where we think inflation and economic growth are going, I just want to sort of highlight this link between why we care so much about inflation and how that translates through the Fed into the real economy, and more importantly for us here today, into investment markets. I've got a little table here of how we think the central banks work here. I've used the US as kind of the poster child for domestic, for global central banks in developed markets. And this blue dotted line indicates kind of the ideal environment for economies to be operating in, where you've got a little bit of inflation to keep pushing things forward. You've got pretty decent employment, but not too much. And central banks can keep rates at a reasonable level. And economies are a bit like riding bicycles. You want them to be operating at a decent speed, not going too slowly and running the risk of kind of slowing down too much and falling over, and also not going too fast and running the risk of kind of ending up with a messy, catastrophic crash. And so the central bank's role here is to just keep the economy going at an optimal speed, which is what we think that's happening around about this blue bar here. So when the economy starts to get a little bit hot at the top here, inflation is running above 2% and labor markets are getting a little bit tight, wages are starting to accelerate, or wage growth is starting to accelerate. Or the flip side of that, when economies start to slow down too much to the extent that inflation is dying out and there's excess slack in the labor market, people can't find jobs, the central bank steps in and starts sort of pushing the economy either to go faster or to go slower. And when we get that journey, when the central bank starts stepping in, so let's assume for this first arrow over here, the economy is starting to pick up speed and go faster and faster. In that environment, the Fed is slowly starting to suck liquidity out of the market, and that usually acts as a headwind for us as investors, for asset prices struggle to go higher in that environment. And the flip side of that is when the economy starts to slow down and is heading towards going too slowly, the Fed again steps in and starts pushing liquidity back into the markets, and that's usually a tailwind for investors. Now, the good news is you don't actually have to get into this optimal economic environment for asset prices to start responding. So as soon as the Fed starts heading in a tightening monetary policy environment, asset prices start to feel the pain, whether they're going from a sort of too slow environment to a neutral environment or from neutral to fast. And likewise, even if you're already in a very restrictive or an economy that's too hot, as soon as the Fed starts stepping on the brakes a little bit, asset prices tend to, or taking their foot off the brake a little bit, asset prices start to tend to feel the momentum of that. And that's relatively good news for us because we think we're currently in this pretty tough environment where inflation is way too high, wage growth is way too fast, and unemployment is relatively tight. But we think the good news is that we're heading towards this transition where the Fed will start, they've probably got a few more months of being incrementally more restrictive, but then we can start to see, at least in our 12-month investment horizon, the Fed shifting direction. And certainly towards the end of 2023, we start to see an environment where the Fed's acting as a tailwind for asset prices. And that's part of the reason we're relatively constructive on asset prices this year. Now, this is kind of where markets think US inflation is going to go. This the sort of stepped solid line is where we've been on inflation. So, middle of last year, US headline inflation was at 9%. It's been stepping steadily off from that level. And then the dotted line is where investors in aggregate think it's going. And aggregate investors think that inflation will be largely under control by the middle of this year, which will again allow the Fed to take the foot off the brake and maybe even start putting it on the accelerator, which we think is constructive for investors. This is just the path that the Fed's taken. This is a chart in this black line of US interest rates. And you can see here that from March last year, the Fed really put their foot on the brakes pretty hard. Hiked rates by 4.5%, did it quicker than we've seen at any time in the last 4 years. But the important part for us is going forward. And here's where you've got quite a slight disagreement. So the brown line is the quarterly survey of the actual Fed members. Survey was done mid-December. And the Fed members think they're going to have to keep putting the foot on the brake for the rest of 2023 and keep it there. But the blue line is where investors think we're going. And the blue line suggests that towards the middle of the year, the Fed can actually start taking its foot off the brake. And we can see that headwind start turning into a tailwind. And we're largely on this page. We think that towards the end of this 12-month horizon, we can certainly expect to see there being a little bit of a tailwind from central banks coming to bail investors out. Now I'm gonna leave it with this slide. This is just the major global economies and South Africa and where we think sort of the growth, economic growth, inflation rates, etc. will be. And I think the one thing that we can say for developed markets in the Western world, this is probably the most anticipated economic downturn in 2023. So everybody assumes that economic growth is going to be mediocre. Inflation is going to be above average, unemployment is starting to get worse. And we're largely on that pace. We think the economic environment will get tougher in 2023. But what informs our constructive view on asset prices or investments in that environment is that investors in the back end of this year will start to look through that to an environment where we think economic growth will start to improve going forward, and certainly central banks will be supportive. The one that stands out probably is China, which is actually coming off a pretty low base and should have actually a fairly decent year this year. And that's good for South Africa. Peter Armitage will go into that a little bit in detail in his section. And I'll leave Nolan to kind of touch on the South African economic environment. So with that, I'm actually going to hand it over to Nolan, and he can take you through the individual.
Peter, thank you very much for the introduction, and hello everybody. It's lovely to be back again, to be speaking to so many people, and thank you for your time and for actually dialing in. As Peter said, I'm really responsible for fixed income here at Anchor. So I'm going to talk for the next 15-20 minutes about fixed income, global, domestic. I'm going to touch on what that means for the Rand, and then I'm going to hand over to Peter Armitage to talk about the equity side of things. So Peter Little introduced us a little bit to the view on global inflation. He had that chart where you could see inflation expectations for inflation to come down. But the number one question that continues to abound is, what does that mean for global interest rates? How much higher are they going, and how long are they going to be higher? So let's actually look at what the Fed says in that quarterly survey that Peter Little was talking about. And specifically what we've got in front of us here is a chart that the Fed produces quarterly, and it shows what they do is they go to all the members of the actual Federal Reserve Committee, the guys who actually sit and hike interest rates in the USA, and they ask them to project where they think interest rates are going to be at the end of 2022. And you can see everybody in December knew exactly what was going to happen. But then they ask them, where do they think interest rates will be at the end of 23, at the end of 2024, 2025, and in the long term? And let's just look at what the Fed members are actually saying to us. The first thing is that there isn't a single Fed member who thinks interest rates are going to stay at current levels. Everybody expects that interest rates are going to continue to go up. We are still in a rate hiking cycle. However, the extent of that hiking cycle is quite muted. And basically what they're saying is, if you take the sort of average numbers here, interest rates in the USA are going up to about 5.25%, give or take. and that from 4.5 right now. So what they're really saying to us is 3 interest rate hikes of 0.25% each. That's the expectation for 2023. As Pete Little said, they don't expect to cut rates this year. The market thinks that pressure might start to build for rate cuts later on this year. Moving into next year, it's very clear that the majority of, or moving into 2024, it's very clear that the majority of members expect interest rates are going to come down again. And then in 2025, rates are coming down further. So basically, the Fed is saying interest rates are going up by about 0.75% for the next year. It's going to hover around there for a year, and then we're gradually going to bring rates down. If you look at the last sort of set of dots here on the right-hand side, the question is, where's the long-term interest rate? What do you think the neutral interest rate is for the US? And the answer seems to be the Fed thinks it's about 2.5%. Currently, we're at about 4.5%. So long-term, the Fed expects interest rate cuts of about 2% to come through the market. First, we're going to go up a bit, and then they're going to cut, and they're going to cut all the way to about 2.5%. So that gives you a sense of what they're looking to achieve, what they're looking to do. My objective, though, is to say, well, I've got to actually value a bond based on this. And what's the fair value of the bond? Well, actually, the fair value of a 10-year bond is basically the average interest rate of what interest rates will be next year, the year after that, the year after that, and in fact, all 10 years. Just average out those expected interest rates. And you're going to come, when you do the maths, to an expected yield of about 3.5% right now. That's kind of where bonds are right now. So basically, if you go and do this whole exercise, what you're going to come out with is that global fixed income bonds are at about fairly priced. We are going to see positive real rates. In other words, interest income will actually exceed inflation for the first time in a while. Cash in particular is going to be quite interesting. You'll be able to find money market funds with sort of 4 or 5% yields potentially. And volatility is going to reduce as we get through inflation and we get more certainty about the future. So what does this mean? Where does Anchor think that investors should be looking? We actually think that a yield of 6% or thereabouts is possible with potential capital gains on global income. Specifically, we like the Anchor Global High Yield Fund, which is a portfolio that focuses on South African corporates that have issued dollar bonds. 100% dollar assets, but we're able to yield about 6% returns, which is quite a nice return for investors, very short duration, so market volatility is actually quite measured. Looking domestically, though, what do we think about domestic fixed income? And looking at the domestic environment, unfortunately, starting on the left-hand pane, we have to start by saying any forecast for South Africa is really about a forecast for Eskom these days. So Eskom had a press statement yesterday where they basically said load shedding level stage 2, stage 3 for the next 2 years. And then today they basically have tried to walk that back and said, hey, it might get worse, it might get better. So the long and the short of it is projecting Eskom's outcome, projecting load shedding is kind of impossible right now. They're not able to get it right themselves. I could actually sit here and rant about Eskom and the events for the next hour, but I don't want to do that. What I will say is, firstly, it's clear that it's going to get worse before it gets better. I think the other thing we can say is that, the plans to really alleviate the problems are just that. They're sort of plans and people talking around the table. Very little has been actioned at this stage. And, from that perspective, I think this is the big challenge for South Africa. No soft soaping that. That being said, though, looking at the middle pane, my job is to look at what that means for the rands and cents. What does it mean for South Africa's economy? What does it mean for the fiscus? What does it mean for our current account? And surprisingly, at the moment, it's not too bad. I think the longer it drags on, the worse it gets, make no mistake. But if you think about that slide Peter Little had up, we're expecting South Africa's economic growth rate to be 1.3%. In of itself, disappointing, paltry outcome, and we should be doing a lot better. However, in the context of 2023, where the US is going to grow at 0.3%, where the Eurozone is probably going to grow at 0%, if you're going to have a bad year, it's not the worst time to have a bad year. And one of the factors that actually does support us, is the China reopening, which will keep a bit of a bid for our commodities, etc., as long as we have enough power to get them out the ground. In the context of what that means for South Africa's fiscal situation, the reality is, if you go and look on YouTube, you'll probably find a video of me doing a Where Will the Money Be Made, maybe 2 years old, where we were talking about South Africa's debt levels rising to 90% of GDP. The reality is we're actually now only at 70%. So there's been a massive outperformance where we've been able to achieve lower debt levels than forecast. And that's for a variety of reasons. Our economy bounced back quicker, commodities have helped us, excess tax collection, etc. But the reality is we're in a better place than we thought we would be. Coupled with that is, if we look forward to the budget, which we're expecting in February, we're actually expecting that the finance minister is going to say that our debt levels are probably going to continue to hover around the 70% for the next 2 to 3 years. In of itself, that's also a good outcome. They're no longer getting worse at a rapid rate, and actually they're broadly moving sideways, or at least that's what the forecast will say. We're achieving that partly because we have definitely had some benefits from faster economic growth last year from commodities. We're also unfortunately going to be achieving that because the minister is going to be a little bit more aggressive in some of his assumptions. But even so, the reasonable outcome is that we're going to be a heck of a lot better off than we thought. So that's a positive for South Africa compared to what we're talking about. The other point is the current account, which basically says, how much does, in a nutshell, it's kind of how much does South Africa import, how much does it export, and what's the balance? And, are we net generating foreign currency or losing foreign currency? A lot of other factors that go into there that get complex, but just, summarizing at a high level. Looking at that, what you're going to see is last year we were expecting a negative current account deficit. In other words, South Africa was net using up foreign reserves. We ended up in a net surplus because commodity prices were a lot higher than expected. Going into 2023, we're expecting a small current account deficit, but the point is it's quite small. It's quite manageable. We're not expecting commodities to roll over. And as a result, actually, from a where we're at perspective in South Africa, again, not too bad. So the fiscal situation is actually possibly a little bit better than people expected. But looking right on the right-hand side, you've got someone filling up a car, and inflation continues to be a problem. South African inflation is at 7.2% at the moment, as measured by Stats SA. The truth is we've got petrol price hikes coming at the end of this month. I think they could be a lot more substantial than people are talking about. That long-term South Africa's inflation is of concern. Inflationary drivers in South Africa are threefold. It is the price of energy, i.e. the price of petrol, going up in the short term, but over the long term, we think that that's going to, at least petrol price inflation will abate. If anything, it's probably going to track sideways at about 0% inflation for a while. The next concern is food. Food inflation has been quite significant over the last year. For many jurisdictions, we are seeing food inflation actually coming down. I think, that does appear to be a global phenomena. My concern is that load shedding is impacting food production in South Africa, so there is a risk there. And the final source of South African inflation is Eskom tariffs. 18% tariff is ridiculous in a country that's trying to achieve a 4.5% inflation rate. I saw that President Ramaphosa made some announcements on this. I don't know how real or not those announcements are, but it doesn't really matter. The biggest challenge we've got is, the price of electricity and the price of other fuels. Looking at all of this, we do think that, once you sort of boil it all up, the inflation rate is going to come down, but it's probably not going to come down as far as people are hoping, and maybe 5.5% or so. So that means South Africa is also in a rate hiking cycle, and most likely we probably mirror what the US is doing. So we're talking, 2 or 3 interest rate hikes here as well to the peak. Looking at this chart, which I like, so I've shown it a few times actually, what you have got, just to sort of pull together what this all means for investors, is the yield on bonds over time. You can see how the yield is moving up and down, and you can see the blue line, the jagged line, is probably a little bit higher in more recent times. Against that, I've got a red dotted line, which shows you where the yield is today, and you can see that sort of from where the graph ends, and I just take a sort of line sideways from there. The point we're making is that the yield on this 2030 bond continues to be higher than it's been pretty much through most of its history, other than either the recent past or the period of COVID. So basically what this is saying is if you invest in South African fixed income, if you invest in South African bonds, you're able to earn more today than you have been at almost any point in time, notwithstanding, slightly better fundamentals, notwithstanding inflation that is tracking lower, notwithstanding a slightly more supportive global environment. So from that perspective, we continue to think that the domestic bonds offer an attractive investment destination. And pulling it all together, what does this mean? Domestic bonds are appealing. Fundamentals are reasonable, global rates are becoming supportive, and where do we think investors should be looking? Well, a yield of 11% is attractive, the Anchor BCI Globe bond fund, and you'll see that the bond fund naturally has a bit of volatility, but we think that the risks are skewed in your favor. A lot of investors these days are actually favoring stable outcomes. I think people are a little bit tired, a little bit bruised. And we caution against wholesale changes or knee-jerk reactions. But what I will say is that for people who just want a stable investment destination for a while, the Anchor BCI Core Income Fund provides an attractive yield, 8.5%, probably soon to be 8.75% running yield for investors, and it's with the objective of a very low market volatility. So those are some of the options that we are talking to investors about at the moment. Pulling it together though, final comments from me is on the Rand views, and this is a chart you may well be familiar with. The chart shows you the sort of thick bar in the middle, which is the Anchor modeled purchasing power parity fair value of the Rand. And that basically assumes that the Rand is depreciating against the dollar by inflation over time, by the net inflation differential. Against that, you've got the jagged blue line, which is where the Rand's been, and basically everywhere except the model value, the Rand is incredibly difficult to predict. The point I'd make, though, is if you look far on the right-hand side, the Rand is significantly weaker than the model suggests. Now, each time, whether you look at 2001, 2008, 2015, 2020, that the Rand has been materially weaker than the modeled value, the Rand has actually pulled back to the modeled values. There's been a sort of reversion to modeled value over time. I don't want to say this is any different. I think that in time, it's very plausible that the Rand will revert towards the modeled value. But I don't think this time around it's going to be a sort of race to the modeled value. I think there are certain factors that will keep the Rand a little bit above the model value for a while. So what we're doing is projecting a sort of gradual narrowing of that gap, if I can talk about it that way. And we're saying a reasonable target for the Rand by year end is sort of 16 to 16.75 against the dollar, a sliver stronger than we are today. And then potentially further Rand strength to come in time. So that's how we're looking at the Rand as well. With that, I'm going to end my presentation and I'm going to hand over to Peter Armitage to take you through Anchor's equity views. Thank you.
Hi folks, it's great to see you all. Starting off a new year with a bit of a blank sheet of paper, looking at things to see where we sit. Obviously, if one looks back to 2022, for global investors, it was really a terrible time to be invested in equity markets. On the South African market, not nearly as bad. Most portfolios got a positive return. And I think a reminder that international investing and South African investing are two fundamentally very different things because the drivers of the markets are very different. On the one side, you've got the US market, which is dominated by US and developed markets GDP growth, with 5,000 or 6,000 shares to choose from. In the South African market, there's basically 40 to 50 shares that comprise 80 to 90% of the market, and much more driven by China and emerging markets than the other way around. So where do we find ourselves today? I think the we're coming out with a fairly positive outlook on both domestic and global equities for different reasons somewhat. But ultimately, domestic equities, after reaching all-time highs, which scares people a little bit, I think one of the things to understand is that going back 2 years ago, we never really had a bubble in domestic equities. So the muted return last year, but albeit positive, was one of the best equity returns around the world. But during the last few years, if you remember back to 3 to 5 years ago, very little return from the market for quite some time. And while that's been happening, the value of NASPAS has gone up. Miners are having record profits. Banks have grown their earnings by 10 to 15% a year, and the currency has shown a bit of weakness. So if we put it all together, we think another double-digit return from the local market is in prospect. And that's predominantly driven by China, which we'll talk through a little bit more. But ultimately, the local market, the SA Inc. shares that are about 40% of the market, we think the SA conditions are obviously quite difficult, with the returns coming out of the stuff that's driven by things other than South Africa. Despite the fact that the market's at record highs, it's sitting at a valuation roughly half of other global comparables, and dividend yields of about 5% are attractive. So over time, we do favor global equities, much more opportunity, much higher GDP growth. But I don't think one should just dismiss the fact and assume that global equities are going to outperform every year. In the coming year, we expect about a 10% return for global equities. It's quite interesting where we're at in the market at the moment. If you look at all the major global investment banks and you look at their projections for the S&P to the end of the year, they really don't know what to think. And they're all tightly in a band around kind of the 4,000 level, which is a flat to 5% return over the course of 2023. I think one of the things that we know for sure is it's not going to be a flat return. Our base case is up about 10%. Now, that's not terribly bullish, bearing in mind that markets are down 20 to 30% last year, depending on the segment of the market. But we're indicating a positive bent. And there's no doubt that the economy in the US is going to come under some pressure over the course of this year and through Europe. But ultimately, once the economy turns, interest rates have peaked and inflation is coming down strongly. You want to be in the market before that. By the time all of that happens, it'll be way too late. So I think if you genuinely are looking out 12 months, we've got a positive view on the market. And also, so we think it's probably pricing in the economic and earnings pressure to come. And also to remember, we often talk about US GDP growth, but as the previous speakers have shown you, China, the second biggest economy in the world, growing at about 5%, so propping all of it up. So you want to own equities long before the economy bottoms. And what we find particularly exciting is below index level. And it's difficult to have massive projections for index levels because shares are not, on average, very cheap. We think they're in good value territory. But the premium that you're paying for growth companies is pretty low and the lowest in many years. So good quality businesses got quite inflated. If you look back kind of 18 months or so ago, and you can now buy them on the other end of the spectrum where they're pretty cheap. So this is the backdrop for the world GDP growth. And you can see in 2023, we're talking about the lowest in many years, but we think a lot of that is priced in. And if you look out to 2024, you face the prospect of potentially some really nice global synchronized growth, where the US economy probably would have been through a minor recession, and hopefully the 2024 prospects looking a bit better. And at the same time, China is still growing at a reasonable rate. So the question is, have we reached a bottom? I think, we don't want to send the message that we are absolutely positive and certain what's going to happen. I think you can expect some more volatility. What we're seeing at the moment is every time inflation numbers come out, if they're a little bit ahead or behind of expectations, you do see some quite big moves in the market. So the market's still quite sensitive to short-term data. But to put it in context, at the beginning of 2022, the market reached an all-time high. This is the US S&P 500 for 4,800, and then bottomed in October last year at 3,600. So about a 25% dip. And that quantum of dip generally sees the market kick up after that. So you've had some element of recovery, and what we're projecting is a slow recovery with some volatility. I think you can go down from here still, but ending the year in the kind of 4,200 to 4,300 level. Just a reminder of what you experienced in 2022. So you can see the year to date, effectively negatives right across the board. And you kind of had to be in energy shares or the Brazilian Bovespa to get a positive return from a dollar perspective. So anybody who was invested in equities around the world, measured in dollars, had a torrid time. And we think you'll have a reasonable this year, but probably not recover everything that was lost in the 2022 year. So we think interest rates will peak in the next 3 to 9 months. We think in 9 months' time, the economic outlook for the world will look far rosier. And there's certainly an argument for a healthy valuation. I think also from a market's point of view, they're pretty pessimistic at the moment. Everybody's talking about a recession. Nobody's prepared to be bullish in terms of returns for the year. And generally, when there's a broad consensus on anything, what you tend to have is, that tends to be wrong when everybody thinks something's going one way. So some positive news can have a pretty positive impact. And then, just to make the point, it's not just about indexes. There's some very attractive shares out there. Some of the world's best and biggest companies are down 20, 30, 40, 50%. And our job and how we think we're positioned at the moment is to be in quality growth companies where their valuations now reflect good value. Importantly, and I've got a graph coming up, the dollar has declined sharply from its highs, and that has quite a big impact on markets going forward. And also, if you look in portfolios, people are very cautious. There's plenty of cash in the sidelines. And I think people are, nervous of markets, but everybody's lost money over the course of the last 12 months. So they want to make sure that they're in the market when it kicks back. So this is the dollar against the euro over the course of the last 2 years. And you can see if you go back to the beginning of 2021, or in fact, most of the first half of 2021, you had a dollar euro around 120 to 125. That hit 0.96 in October last year. So that's 30% stronger. Now, in the US market, about 40% of earnings come from outside the US. And, if the dollar is extremely strong, it means when you convert those earnings back into America, they're worth less dollars. So that had a fairly negative impact on earnings in America over the course of the last 6 months. And we think that'll start to reverse. So the dollar had a dampening effect in earnings in 2022. But if the current trends are sustained, it'll be a positive impact in 2023. So there's lots of economists and strategists and market experts out there and who give their views and statistics. But what we value very highly is the actual views of the companies. Now, the big 5 banks in America have just announced results over the course of the last week to 10 days. And we pay a lot of attention to what they say. So these are the statements from the CEOs of the big banks, giving you an up-to-date live appreciation of exactly what's happening in the economy. And if you go through them, the basic summary is that things are still pretty strong out there. People are getting more cautious, but all of the banks think that there's just rhetoric coming from the Fed and that further rate hikes will be fairly limited. Goldman Sachs indicating there aren't many signs of widespread distress, but CEOs and boards are cautious. JP Morgan saying US consumers and small business still on a solid footing. They're saying they expect a mild recession, but a cut in rates later on in the year. The Bank of America is saying asset quality of customers remains very healthy. They're seeing they're still spending money, but the credit card charge-offs are getting a little bit higher, and they too are expecting a mild recession. So it's kind of a bit of what we call in the markets a Goldilocks scenario. If there's no recession or just a mild recession, they stop cutting rates and they kind of manage their way through the cycle, start bringing inflation down. That's a set of circumstances which would be positive for global equities. Morgan Stanley, they don't think we're heading into kind of a dark period. They're making quite a big and contentious statement that there'll be 0 rate increases in 2023. That could be proved wrong quite shortly. Wells Fargo is seeing an impact on consumer spending, credits and housing demand for goods, but the rate of impact is not accelerating. So that's a fair, up-to-date picture of exactly what's happening to the US economy out there. From a value perspective, we can see, looking back with the benefit of hindsight, the market got way too expensive in 2021, and it's now come back down to much more reasonable levels. The world forward PE multiple sitting at about a forward 15, and if there's reasonable earnings growth thereafter, that's a set of circumstances which would lead you to want to be invested in the market, in the right segments of the market. I think another thing to bear in mind in 2021, you had some decent performance out of energy shares and very defensive companies. So those have stayed at quite high multiples or unchanged multiples, and you've had growth shares going from overvalued to, in some instances, undervalued. The US market isn't as cheap, and this is, provides some indication that certainly from a numerical perspective, it's difficult to project enormous returns out of the S&P, but it's important to understand the constituents of a market, where if you take out the FANG shares out of the S&P, that forward 17 multiple goes to about 14. And within that, there's banks and some companies where we think are reasonable quality that are trading at pretty attractive multiples. This is the consensus numbers from Bloomberg in terms of the S&P earnings. We've taken out energy because that's extremely volatile. But I think the key message is it looks like earnings outside of energy in America were roughly flat last year. You must remember a big driver of that is the 40% that comes out of the US. Is under pressure from a currency point of view, and we think that'll reverse a little bit in 2023. So consensus earnings are for reasonable and kind of more trend line earnings growth of early single digits in 2023, and then a bit of a bounce back in 2024. Now, the risk to the market, and what everybody's scared about, and might well be the case, is some earnings pressure coming through from the economic conditions that we're talking about. So just to do some basic maths, the forward EPS numbers in the S&P, earnings per share is about $240. So to put that in context, at a 10p multiple, that would put the S&P at 2,400. So the S&P is currently sitting around the 4,000 level, and we're saying at the end of the year, at 4,200, that would give you a PE multiple of about 17.5 and a forward PE multiple of 16 times, which is below the long-term average. So it's quite plausible that the world will look a lot rosier. We would have gone through the angst of inflation and interest rates that we've been experienced for the last 6 months, and we'll probably experience for the next few months. And another way to look at it, because PE multiples don't intuitively sometimes mean a hell of a lot to people, if you do 1 over the PE multiple, that's basically the earnings yield of a company. So that's the percentage that you're getting, that you're paying as a percentage of the earnings of a company. Now, if you compare that to the bond yield, so if you lend money to Joe Biden and you buy a 10-year bond, you're getting a 3.5% yield. Now, that's considered the least riskiest asset in the world because the American government can always print money and pay you back. So in order to own shares, you'd like to get an earnings yield above that 3.5%. And usually what the market's looking for is about 2.5 to 3.5% above the bond yield. So the PE multiple that we're talking about kind of fits in that range, indicating again that the market as a whole is not in bargain territory, but it's kind of at the level that it's compensating you for taking equity risk. Moving then into South Africa, where shares are a lot cheaper. It's a very different market to global developed markets. And in this slide, I just wanted to indicate and highlight the extent to which our market is driven by China. A lot of people are nervous about the SA market because of SA Inc. and load shedding and the like. And so you should be. I think there's certainly companies that will really battle to grow in a 1% GDP growth environment. And we're certainly sticking with the highest quality companies in terms of getting our exposure. But if you look a step deeper, Naspers, Prosus, Richemont, the commodities companies, China is the biggest driver. And we've seen a massive turnaround post-October, November last year, where China's opened up and they're back on a growth path where they're undertaking significant stimulus. And their stimulus in their economy has worked almost at all times over the course of the last 10 to 20 years. And that's the key reason why we're still fairly positive on the SA market. In talking about a 13% odd return, that's not a number we just pluck out the sky. There's maths behind all of it, and we've gone through the various sectors, looking at the 2-year annual returns that we're projecting. And you can see the major drivers of the returns are, in fact, the things that are influenced by China. So the miners 20% plus, Naspers 18% plus. And then the big head scratcher on our market is Sasol. At the current chemical and oil prices, the run rate earnings of Sasol is in excess of 60 Rand, and the share is trading at below 300 Rand. So it's somewhere between a 3 and a 4 P multiple, and our feeling is it simply has to re-rate once it releases earnings, and gives people some comfort that it can actually generate the numbers that it has the potential to return. So our current positioning, this is in our BCI equity fund, is we underweight the domestic shares for the reasons that we've indicated. We're fairly full of commodity shares at the moment, and we feel it does make sense to have a healthy, here we say 22% offshore equity exposure. We think over time that's where the real money will get made. But going into this year, one wants to have exposure on that side of things. So we're holding the line on offshore allocation. We think the performance of offshore equities will mean revert over the next 12 months. So we think, if anything, perhaps a better return out of domestic equities for 3 to 6 months, and then starting to shift into the global equity perspective. On the JSE, we're positioned in large cap, best-in-class businesses. In a low-growth environment, you don't want to be in the low-quality businesses. So we're sticking with what we consider the growth companies, the companies that can leverage off and manage their business cleverly through tough economic times. Our South African model portfolio, you can see on the right-hand side, is dominated by companies that are driven by China. They've got some nice bottom-up stories, good management teams, and it's only really once you get to the second half that there's some South African-specific opportunities. Our top picks at a 12-month view: Naspers, Glencore, Transaction Capital, Bidcorp, Stadio, MTN, and Advotech. We love talking shares. We put out lots of commentary on these, and if anybody wants to engage with us to discuss any of these things further, that's certainly kind of what we try to achieve. But it's, people talk indexes and market levels. Ultimately, when you get down to individual companies, you can tell, quite a compelling story, certainly for the top 10 or 15 shares in the local equity fund. So coming back to where we started, where will the money be made? After a terrible global equity experience last year for almost all investors around the world, where global equities fell 15 to 45%, depending on the index that you're in. We do expect some recovery this year, not to the extent of the fall last year, but we think as we move to the end of this year, the economic outlook and the inflation and interest rate outlook will look very different. And it certainly is time to be doing the work to finding the growth shares where you're not having to pay the kind of premium that you had to pay for the last 5 years. From a domestic perspective, SA shares are pretty cheap. You've already had an excellent return from local markets over the course of the first few weeks of this year. So there probably is a bit of time for a pullback, but South African shares are still cheap and some quite nice growth momentum, but it's very important to be in the right sectors. So thank you very much, folks, to all of, there's 800 or 900 of you listening out there. It's great to be able to share the views with you. I'm now going to hand over to Seleho to talk about ESG, and it's certainly a topic that's changed dramatically over the course of the last year. A lot of global investors are investing with this as a backdrop, so it can't be ignored from an investment perspective. Over to you, Seleho.
Thanks, Pete. Yeah, so I'm going to talk about climate change within the context of financial markets. It's a topic that can get political at times, but we really just want to look at what this could mean for investors. And there are 3 things we want to look at. It's the challenge, the opportunity. Hopefully that gets some of you excited. And then thirdly, how do you actually try and implement this in portfolios? So where do you look to actually try and take advantage of this theme? Okay, so let's start with the challenge. In very simple, broad terms, the challenge is that as greenhouse gas emissions rise, global average temperatures increase alongside it. So if you look at this chart here, if you look at the chart on the right showing the global average temperature change since 1850, you can see that temperatures today are roughly 1.3 degrees Celsius higher than they were in 1850. The reason why the chart's looking at 1850 is that that's sort of a measure of pre-industrial times. So to address this, the Paris Agreement was signed in 2015. It's an agreement that's technically legally binding, and the idea of the agreement is to limit this temperature increase to below 2 degrees Celsius by 2050. So over the next 27 years. And I guess the challenge that we have is that if you look on the left, we haven't really addressed the increase in greenhouse gas emissions. And if anything, it's getting worse by the year rather than better. But we'll talk a little bit about that as we go on. Now, the other challenge is that as countries or societies grow in terms of income per person, naturally their energy use per person grows alongside it. And you see this very strong correlation in this chart here. It's for a variety of different countries. And so obviously we want low-income countries to grow and develop and rise. But the consequence or an unintended consequence of that is as that happens, naturally we are going to see emissions from those countries rise quite significantly. And probably the best example or simplest example of this is China. They've been really fantastic in pulling millions of people out of poverty through economic growth, which is fantastic. But an unintended consequence of that has been that their emissions have risen really dramatically. They've nearly tripled over the past couple of decades, making them now the biggest emitter on absolute terms. And so obviously we do want to continue to see this economic growth, but it is going to come with higher emissions as a global economy. The other challenge is that the way our economy is structured, it's still really structured around fossil fuels. So fossil fuels make up roughly over 2/3 of global power generation still today. And so for all of the talk that we hear about coal being a dead relic or oil being a thing of the past, if you actually look at the stats, coal is still by some distance the world's biggest source of electricity. And it's been pretty steady. If you look at it over time, it has actually been pretty steady. And so the way we're structured as an economy, it's going to take time for us to make this transition. And the issue is, those 2/3 of power coming from fossil fuels, those fossil fuels obviously have additional, let's say, challenges or health challenges related to them. So this is just one example of that this is deaths per terawatt hour. And you can see that although coal is the cheapest source generally of electricity, it is also the most dangerous if you look at this chart. Okay, so that's a very brief summary of why this is a challenge, but let's get on to maybe the more exciting part of this. So what's the opportunity of this? The first is that energy transitions generally take time, but it looks like this transition may have to happen a little bit quicker than what we're used to. So what this chart shows is it shows for different energy sources, so that's coal, oil, and natural gas. It shows their first 60 years as an energy source and how they ramped up from 0% and how big of the global energy supply they became. So you can see that coal went from 0 to just under 50% in its first 60 years. Oil got to just under 40% in its first 60 years. Natural gas got to about 20% in its first 60 years. Renewables today are at roughly 11%. But if we think back to that Paris Agreement we talked about earlier, that's targeting a drop in emissions by 2050 or minimizing the temperature increase by 2050. So that's roughly 3 decades from now. So we're talking about a big shift in the economy over 3 decades rather than what we've seen here over 6. And so as a result, the shift we see could happen over a much shorter time period than we used to. And as a result of that, the shift in capital might be a lot more swift than what we might expect or what we are used to. So this is the first reason why we think this could be a really meaningful opportunity for us as investors. The second is that climate change is not just about electricity. I myself was surprised when I learned that electricity is only about 27% of greenhouse gas emissions. Climate change really touches every part of our lives. So the biggest emitter or contributor is actually manufacturing or making things. That's about 31%. The three biggest, let's say, emitters are the production of cement, steel, and plastic, but obviously there's a host of other things. Then we have electricity, then growing things. So that's farming and agriculture. That's just under 20%. Transport or getting around is 16%. And then heating, cooling, and refrigeration is about 7%. So I think sometimes, we can fall into the trap of thinking climate change is just siphoned off to the energy sector, but that's absolutely not the case. This is touching and going to touch every part of our lives. And if you just think about your typical day, or maybe your day so far today, you woke up, you hopefully brushed your teeth. Your toothbrush would have contained plastic from fossil fuels. You would have gotten dressed. Your clothes, some of your clothing might have had cotton. That cotton would have been fertilized and harvested. That's gonna contribute to emissions. You would have gotten in your car, unless you had a battery electric vehicle. You probably would have burned a fuel that would have contributed to emissions. So, every part of our lives is touched by this issue. And so, to sum it up very briefly, this is why we think this is a meaningful opportunity. It's firstly that we think this shift is going to happen quite quickly, maybe quicker than some investors may think. And then secondly, it's that this isn't just an energy sector issue. This is going to touch every part of the global economy. Let's talk about how we can practically try and take advantage of this in portfolios. So the first is through a sector that we've talked about many times before in these webinars, and that is the commodities or basic materials sector. This chart here shows the potential increase in demand for select commodities between now and 2050. And you can see for cobalt, copper, nickel, and zinc, there's the potential to have really massive, significant demand increases over the next 3 decades. Cobalt in particular could quintuple over that period. But even for something like copper, a really good example is that a battery electric vehicle uses 3 to 4 times as much copper as a traditional internal combustion engine does. And obviously, as battery cars become a bigger proportion of global annual car sales, that's going to be beneficial for copper. I think battery electric cars were 10% of total sales last year globally. So that is ramping up. But this is the first way we think you can try to take advantage of this theme. If you look on the JSE, probably some of the best placed companies to do this through are Glencore and South32. So Glencore is really strong in these metals here. South32 as well is moving in this direction. And actually the sector as a whole, mining companies, I think over the past, let's say 2 to 3 years, have started to throw money at copper assets in particular. But all these commodities in general, they've really tried to make a shift towards these commodities. The second is through fossil fuel deficits, so supply-demand mismatches. We think this could be a potential way to take advantage of this theme. The example we've gone with here is thermal coal, just because I think it's quite familiar to all of us. Last year, 2022, was the best year on record for thermal coal, reaching all-time highs. Even the average price throughout the year was by far the best on record. Now, this was obviously significantly helped by what happened in Ukraine with Russia invading. But even outside of that, the point we want to make here is that it's getting harder and harder for fossil fuel companies to gain access to capital markets. So if you look at Thungela, which is a thermal coal company spun out of Anglo's in 2021, they're finding it increasingly difficult to get access to capital, to the point where they're actually self-insuring themselves now. And they're having to keep a really big cash balance on their balance sheet because it's just becoming, the interest rates that they're being charged, or the cost of capital for them, is just becoming prohibitive. And so the amount of money going into new supply for some of these fossil fuels, we think is declining meaningfully. And in the future, you could have more supply-demand mismatches at various points as we transition. And then finally, the third area we would look at would be what we would call companies that are more, we would call them down the value chain. So they're not mining the commodities that we need for this transition, but they're addressing climate change in other ways. This table here shows the top 10 S&P 500 stocks to the end of 2022 over 5 years. And what you can see is that 3 of the top 10, and actually 3 of the top 6, are companies that are directly addressing climate change. So Enphase Energy and Solar Edge are essentially solar stocks. And then Tesla, I think, needs no introduction. That's probably the world's most famous electric car company. But all 3 of these companies are really directly addressing climate change. And we think that, I guess the point to make with this table is that sometimes we can think that climate change is something that we're going to deal with, down the line, something that's kind of around the corner, but it's not happening yet, or the investment opportunity from climate change isn't happening yet. But I think this table shows that it's something that's happening here and now, and has been happening. And although it is dangerous to look at a table of past winners and try to extrapolate that, I do think that's dangerous. But we do think that when we look 5 years from now or 10 years from now, some of the winners over that time period are going to be, just like in this table, companies that are addressing climate change. And so really, the point of this webinar is, or the title is, where will the money be made? And in terms of climate change, we think there's 3 places to look at. So it's firstly upstream, that is commodities or mining companies that are going to benefit from a really strong demand uplift. It's through further potential mismatches in demand supply for certain fossil fuels. And then finally, it's through companies that will be addressing climate change downstream, as we just discussed in that last slide. So that's where we think the money will be made in climate change. I'm going to hand over to Pete Little, who's going to discuss the outlook for 2023 and how it compares to our view last quarter.
Excellent. Thanks, Seleho. Certainly some interesting opportunities to look forward to over a slightly longer term horizon than we've highlighted here. But just to bring this full circle, so I put this up at the beginning of the presentation. This is our view. So Pete talked about why we're fairly constructive on equities, and within that, frankly, there's pockets that we're much more constructive on. Some of the offshore or the global equities where we've seen some pretty big falls in prices for some high quality companies, and domestically, obviously, what happens in China will be pretty interesting for us. Nolan's talked about the bonds and how we think without too much capital gain, and frankly, primarily in interest, you can achieve a pretty decent outcome there domestically. And he's talked a little bit about how we're relatively constructive on the rand. And so I'm gonna leave it there. This is kind of our outcome, fairly constructive. I think a few of you have asked questions. I'll put it back to Neil now, who can maybe moderate some of those questions. Thanks, Neil.
Brilliant. Thank you, Peter. And thank you to all of you that have presented today. If I could ask you, please just put your cameras on and unmute yourselves. What we're going to do now is really run through, and I've got a list of questions that have been posed while we've been sharing. If you guys could please just continue posting your questions in the Q&A. We'll keep going until we run out of questions or run out of time. And I'll do it in an unfiltered way. So the idea is just to pose all the questions that have been asked. So taking it from the top, Paul's asked a question about the percentage of assets that should be invested in the US. So the question is, considering the US consumer's position, current savings and debt levels, plus the valuation issues in the US, do you think it's still prudent to have circa 70% of a global portfolio invested in the USA? I think, Peter, if you could deal with that one, please.
I think a bit of context is always needed. Listed in the USA doesn't necessarily mean US. So, as we said earlier, about 40% of the earnings from the US come from around the world. Over time, the US has been the best place to be because the best companies in the world are listed there. And the tech companies have all tended to be listed there. Very difficult to find a tech company in Europe. And in fact, NASPA's process is the biggest because the money all channels through to America. So it has in the past. So, having 50% in your portfolio that's US domiciled doesn't necessarily mean that that's actual US companies. Emerging markets, which have got a bit more of an intuitive growth story, and you would expect to be better companies over time or better returns over time, in fact, have been dogs for the course of the last decade. The emerging market indexes haven't been great. A few issues, something like India, a lot of the good companies are not listed. It's difficult to get actual exposure to the 7% GDP growth. And then in emerging market indexes, often a country blows up. So, two that spring to mind are Venezuela, if you look back, must have been 5-6 years ago, and then Russia, where suddenly you have 3-5% of the portfolio going to naught. So, as we've talked through, I think the US is in very good shape at the moment. The consumer is very strong. We've showed that, and because of that, they're trying to put the brakes on, and they're doing that fairly effectively. And really, the next 6 months, we'll see the extent to which it slows down and the delicate balancing act that's underway. So, over time, I would think a reasonable proportion of a global equity portfolio to have in the US is probably in the 55 to 70% range, depending on how smart you want to be. But ultimately, we look at the underlying companies more than where they're actually listed.
Well, thanks, Peter, and thanks, Paul, for that question. Jumping to one for Nolan then. And Londiwe asks, as Nolan pointed out, cash and money market funds are getting a boost from the rising interest rates. To what extent do you expect cash to outperform other assets?
Thanks, Neil. I think we don't expect cash to outperform other assets. If you look at the table that Peter Little had up previously, we continue to see the likelihood for higher returns, sort of low double-digit returns from the equity classes, and in fact longer dated bonds, which have a higher yield, certainly domestically, will also probably outperform cash. So by and large, I think cash is a good repository for short-term safety. But even in those cases, I can probably find you better alternatives. With taking measured amounts of risk that will outperform cash.
Thanks, Nolan. Peter, back to you. I'm going to ask you 2 questions. One from Rowley, who asks, do you think we will see a decent pullback, 15 to 20%, in our top 40 this year? It seems very overbought to me, but it's just going up. And linked to that, how does one reconcile the all-time record high JSE to an all-time worst load shedding scenario?
Yeah, I think hopefully we've answered the second one. Where, people always think the South African market is the South African economy. We're probably about 35 to 40% of the South African market is the South African economy. So it's driven by things that are not South African. Do we expect a 15 to 20% pullback? That's not our base case expectation. We're talking about a 10 to 15% return for the year. Market moves at 10 to 15% are not extraordinary. We've had 8% already this year. So, you could easily have a 10% pullback along the journey. With the biggest driver, and I think would be if there was for some reason the Chinese growth and recovery story derailed. Bearing in mind something like a Naspers has gone up 100% since October last year, but is still about 25% below its all-time highs. So, you can't just look at things over short time periods. And if you go back, as I said, 5 years, you get very little return out of the market for a long, long time, as the earnings of South African companies on the market actually grew quite nicely.
Thanks, Peter. Then there's a question from Stephen Delamore, and I'm going to sort of go around the table. I'm going to stick on you first, Pete Little. And then perhaps the rest of you could add any other thoughts that you might have. It's quite a nice question. What kind of black swan events might disrupt the market recovery globally?
Excellent. Yeah, thanks for that, Stephen. I think, I don't know, by that definition, are black swan events unpredictable? So tough one to predict. And I think also, if I remember Nassim Taleb's book correctly, the black swan events are nothing that you've seen in the past. So, I mean, if we were to have a stab at an event that would have a huge impact on markets globally, we'd been talking a little bit last year about China's potential invasion of Taiwan, or at least kind of take over by force I guess that's out there is not necessarily sort of potentially something that comes particularly out of left field, or frankly, something that we haven't seen recently, having gone through the Russian-Ukraine experience, but that certainly would qualify in terms of something that would have a huge impact. That's definitely not our base case scenario. And then I think the one that's probably always lurking under the surface, and that tends to derail markets quite badly, is when you have an economic slowdown and it kind of exposes some sort of credit bubble. So in the global financial crisis, it was obviously the housing bubble. We've had various other credit bubbles in various sectors of the markets, emerging market debt back in '98. So I guess the exposing of some sort of credit bubble that we were not really paying attention to is another potential one. But again, those are certainly not base case scenarios for us. And if we kind of spend our life predicting what could go wrong, I think you'd never invest in risk assets. So we're kind of hopeful we'll skirt through another one without any black swan events, and that's how we're positioning for now.
Yeah, the rest of you have any other thoughts or ideas as to what the black swan could be?
Yeah, I mean, the thing that I'm quite scared of, which is completely unpredictable, is war. I think up until the Russian-Ukraine incidents, we thought that the countries to which we were exposed, that, war was something that happened at extreme countries where the impact on us is quite limited. And I think we get reminded of, human nature, and that there's monsters out there who can embark on and start actions which you would think would be inconceivable in the year 2022. China talking about wanting Taiwan back. TSMC, the biggest Taiwan company, the share price is acting as if that isn't a real threat. But if you said, what are the things that you really wouldn't expect that you're most scared of, that would probably be right up there.
Cool, let's step off that one then. Nolan, will foreign investors' behavior affect the rand's value? What are your expectations? A question from Andrew.
Hi, thanks. Foreign investor behavior clearly does impact the rand's value. Flows in and out have a significant impact. We've seen, for instance, at the time of COVID, massive foreign selling in the rand. Rand popped up to 1936, I think it was. So definitely can do. The question is, what are foreigners likely to do right now? The first point is foreigners have a lighter holding of South African assets. We've come through a risk-off period. There were significant sellers last year. So, when you're underweight, your propensity to sell more and more sort of reduces. So we're certainly not our base case that you're going to see mass foreign selling. And if anything, I think, foreigners are probably a little bit too underweight emerging markets, as Pete was suggesting. What are the risk factors? Much depends on what, how domestic politics play out and load shedding. But for now, foreigners remain sort of neutral / slightly positive. I actually point out that if you look at the credit default swaps premium for South Africa, it's bang in line with that of Brazil. It has been through the last year. Brazil basically had an insurrection, kind of like the US, arguably a coup that was arresting people all over the place because of it. South Africa turned off the lights. But, through all our trials and tribulations, ultimately foreigners do see us as an emerging market. They do stomach a lot of these wild events within their portfolio. And, South Africa actually is tracking in line with peers in terms of current pricing, current financial asset behavior.
Thank you, Nolan. Seleho, one for you. We're technical. Is it true that renewable energy sources such as cobalt, lithium, etc., give off the same, if not more, gas emissions than coal, especially when batteries reach their end of lives?
So in short, no. So I would disagree with that. I think the first points to make is that renewable energy sources like wind or solar have much lower emissions than coal. And then the production and disposal of batteries that have cobalt or lithium the production and disposal, the emissions from that is much lower than the use of coal, the burning of coal. So I would say no. And also the emissions can also be reduced by recycling those batteries. So there are some emissions, but I think it is quite a bit lower than coal.
Okay. So isn't it a free ride, but it's cheaper?
Yes.
Then I think, Peter, Armitage, if you could please deal with this one. Talia's asking, is it purely valuation based? Or are you buoyant on the education theme, considering you have invested in both Stadio and Advitech?
Yeah, so like any industry, there's different parts of it and different exposures. So Stadio is playing in the distance learning segment of the market. They've got about 40,000 distance learning students, and their major competitor and who they're coming up against is UNISA. It's got about 300,000. So we think UNISA is under quite a bit of pressure. Stadio is providing a good service, and we think a really nice growth rate and a great business model. They don't have to build campuses, 40% operating margin. It's just really a sweet spot. The actual physical schooling world with Curo and Advitech, a little bit more difficult. If you build a school, a good school is a great asset, but if you build one in the wrong place, you're not filling it up, it can become more problematic. And that Curo had a few too many of those, and you saw massive share price pressure over the last while. Advitech, we think, has got so Curo, there's quite a bit of upside, but a lot to prove still. Advitech, kind of a much more stable picture, and they've got some interesting opportunities and objectives in Africa, where we think there's some pretty good, decent schools in the private sector in Africa. So education as a whole, I think we're positive, but you've got to be cautious about South African GDP and affordability issues. So it's not this kind of brazen throw all your money at it, but we think there's good bottom-up opportunities for Advitech and Stadio, which are the two that are in our local portfolios.
Thank you. Peter Little, what's our view on the European equity market this year?
Yeah, so Europe often looks a lot cheaper than the US, but a lot of that just has to do with the construction of the European equity indices or the companies listed there. So the European markets tend to be skewed towards what we would consider fairly low growth, low quality, cyclical companies, a lot of banks, insurers, to make things more challenging. They're also running in a significantly higher sort of regulatory environment there, which reduces the return on capital for investors. So we think that if you find good quality growth stories listed in Europe, they don't actually look as cheap as the European stock market in general. So Pete Armitage alluded to this earlier. We're less concerned about where companies are listed and more concerned about finding good bottom-up fundamental stories where there's good growth opportunities at reasonable prices. We think those are a little bit harder to come by in Europe than they are in the US, just by way of the kind of innovation happening in the US relative to Europe. And again, that's largely a function of the regulatory environment there. So I would say Europe was kind of better off last year, where this kind of rising tide lifted all boats, and investors were willing to look into kind of the low growth, the sort of lower growth value part of the market. But we think if you have a long enough horizon, certainly the quality growth part of the market is probably looking at, on a relative basis, a bit more attractive for us than more of the sort of cyclical low growth stuff that we tend to find listed in Europe.
And the UK specifically, comments the same as for your general European comments, or different?
Yeah, certainly the large caps listed in the UK tend to have nothing to do with the UK domestic economy. So it's a lot like our own stock exchange here. The sort of compilation of the stock market is not really a reflection of the economy. And again, a lot of this sort of large listed stuff there tends to be low quality cyclical stuff. If you go further down the chain, sort of into the mid-cap space, where a lot of it is more domestically focused, there might be some interesting opportunities there. but frankly, in the context of the globe, where the UK economy is maybe 2 or 3% of global GDP, it ends up being quite a sort of a niche fishing pond. Not that we haven't gone there before, and we do find some interesting companies there, particularly some of the things like Admiral, for example, really good management, have done some great capital allocation. So there's not to say that we can't find companies there, but certainly the fishing pond is a whole lot bigger outside of the UK.
Thank you. We've mentioned Naspers and Process, but we haven't really specifically spoken about it. There's some questions about Naspers or Process, or Naspers and Process, and how much do we have invested in our portfolios at the moment. So, Mr. Armitage.
So we're bigger in Naspers at the moment. It's got a bigger market weighting. And I mean, as a default, you'd want to be in Naspers. That tends to trade at about a 45 to 50% discount to the underlying assets. Process is sitting more around the 30% level. So with the mechanics underway of them selling stakes in Tencent and buying back their own shares, the impact is obviously much bigger on Naspers because it's buying the asset at a much cheaper price. So there's definite, we're constantly looking at which one to own. Right now we're fairly indifferent, but it's actually quite surprising how broadly apart they can go. So it's not just we typically own a bit of each, but change the weightings either way. But we decided not to talk about Naspers and Process in this presentation because I think South African investors have had a year of it. But certainly the last 4 months been the best share in the market by a mile.
Absolutely. While you're busy, a question around our views on property, both local and global. We haven't really commented too much on that today.
Yeah, so Pete can talk through global. From a local perspective, we're saying kind of muted. You've had quite a big rebound in the kind of bellwether South African companies. And South African property companies are battling to grow. You've still got another year or two of leases. If you've got an office block and you had a 5-year lease, office rentals are down 20 to 40%. So a lot of the leases coming through are getting renewed at much lower rentals. So they've got a portion that's growing with lease escalations, but that's being negated underneath. So, and then they're not paying out all their earnings anymore as dividends. So you're sitting with a reasonable quality portfolio. You're now sitting at probably a 9 to 10% dividend yield. So that's pretty attractive. It almost matches the bond yield that Nolan's talking about. But we don't see a lot of capital growth after the recovery that you've seen in quite a few of the big shares over the course of the last few months. So we'd be underweight. Pete, I don't know if you want to add a comment from a global perspective.
Yeah, so globally, we've seen, obviously, we think we're entering a structurally high interest rate environment, and that's obviously been a tough transition for property shares, given that they're largely bought as a kind of an income-generating asset. So you've seen some derating in global property. I think if you look just broadly at the DM forward dividend yields, DM-listed property forward dividend yields are sort of just north of 4% now, and they've come from probably circa 3%. But in an environment where kind of bond yields have gone up quite a bit more than that, we think that maybe there still needs to be a little bit of pricing adjustment in the listed property sector. So we think there's possibly a little bit of derating still to come. But even with that, you think you're getting about a 4 and a bit% yield. We think that probably those yields can grow at maybe sort of 4 or 5%, particularly given the current inflationary environment. And then a little bit of derating on top of that sort of gets you to a 6 or 7% total return. Obviously, there's sectors or specifically companies within that we think can do a lot better. But just broadly speaking, in an environment where you can kind of get 5% in bonds, which will be much less volatile than listed property, and 10% out of global equities with some pockets that should perform a lot better than that. We don't think we're not particularly excited about global property in that context.
Thank you, Peter. I see we're nearing the end of our time, so I'll do 1 or 2 more questions and then we'll end up. Seleho, over to you. Sasol, data concern? They've not applied capital very well in the past. Can we expect a better outcome in the future?
Yeah, I mean, knock on wood, for now, I don't think debt is a massive concern. From about 2020, when COVID hit, until near the end of last year, Sasol stopped paying a dividend, and they were selling assets and really using the cash they were generating to pay down debt. So they've brought their net debt to EBITDA ratio down to 1, and at that point, they started paying a dividend again. But I think the balance sheet has really been, let's say, restructured or improved quite significantly from those COVID lows. So I don't think it's a huge concern for now.
Okay, thank you. Maybe Peter Armitage, I'll end off with 2 questions for you. The first one on China: is it investable or is it not? And then the tech sector, whether or not at the moment we'd be investing in the technology sector at this point in time at discount levels. Would we be buying an ARC-type fund now, is the question from Kevin.
Yeah, so when the Chinese market crashed 30-40% last year, it was uninvestable. It's now risen 30-40%, and you don't hear that talk anymore. I think the risks in China are much bigger than buying into developed markets. The government has proven to be irregular, to be much more interested in their own 5 or 10-year plans than global investors. So I would certainly approach it with quite a bit of caution. It has, for the last decade or 2 decades, been extremely volatile, and 50% up and down moves are not that unusual, looked at over a timescale. So I think it is very tempting to be invested in the growth stories that come through China. The more conservative investors want to take that through US and other companies that have got Chinese exposure. So for the brave, 5 or 10% in China, when it's looking good, has generally been pretty profitable. But I would certainly keep it down to low single digits as a portion of a portfolio, depending on one's risk profile. The technology sector, I think there's lots of constituents of it. There was a stage where the big 5 technology shares comprised 25 to 30% of the US market. So it certainly was kind of default things to own. I think we haven't been invested in and haven't been tempted into the kind of more speculative, non-profitable type technology companies like ARC. See, the question is, would you buy ARC? I don't think you want to buy an index of those things. I think you've got to have some pretty decent knowledge and choose the ones you want to be invested in. Seleho helps run a global technology fund, which obviously had a terrible year because that sector has been under big pressure. But I think the mix and the approach we take to technology investing, I'm not convinced you get returns in the very short term out of it, but you'd certainly want to, when things have come off so sharply, there's certainly lots of opportunities, and we're sifting through. And the actual underlying trends in the behavior of technology and the appetite, will be sustained for many, many years to come. You've had the market, so the trend is steady. The market got way overinflated. It's now come down. It's probably still a little bit more bottoming out to go. But select shares in the technology company will give you fantastic returns over the next few years.
Brilliant. Thank you so much, everybody. And with that, I think we'll conclude the session. We are out of time. I'm sorry that we haven't got to all of your questions, but appreciate your attendance. We do have a report called the Navigator, which unpacks what we discussed today in much greater detail. And if you haven't already received a copy, please feel free to contact us to send you one. As I mentioned, a reminder, we will be sending CPD points and certificates to those of you that need them. It does take a week or so for us to get the accreditation, so watch out for those. We will also be sending a recording of this session in the next day or so. And of course, as always, if there's anything we can assist you with, please don't hesitate to contact us. But thanks again and have a wonderful week.